So this is part 2 of our budgeting exercise for a complicated household budget. And I'm Elizabeth. I help clients live beyond the budget, but within their means so they can reach their goals. So let's dive in to part 2 here. Great. So it's the planning software I like to use. Again, sample client. I'm going to jump into the budget icon worksheet. Great. So we last left off, we had a zeroed outline item for personal and family expenses because we were interpreting their, spend data, right? And you can see this particular household probably over categorized, and I'm okay with that. I mean, they want to know where they can make an impact, and they have a system for that. There is diminishing returns to perfect data, but I think what we can see is, the personal and family expenses. So food, kids' activities, and that's pretty much most of what I see here. Then personal insurance expenses, everything that's withheld on their paycheck and also their out-of-pocket costs. They have 2 different homes, so we're reflecting both of those here with their expenses broken out. I did put a line item for auto to group that together because conceivably, even when they retire, they're going to have auto expenses and then taxes. Now, the whole point of this exercise is to get one of the clients on top of their estimated tax payments. And I just put an estimate for that client. So we need to start to further refine this data. And that's where budgeting becomes the verb. It's something we do over time. The amount of work this took between the clients and myself, I'd probably say is excessive. You shouldn't do this more than once per year. And even achieving perfect data, I see clients who want like a closed loop, right? They really treat it like a business cash flow. So if your household can withstand that, usually that's households with fewer expenses, fewer complications, one joint checking, one joint saving, and maybe one credit card, and a formal bookkeeping tool to help them keep track of all this. But even then, there's some lumpiness, and you have to look at 12 months worth of data divided by 12 in order to get at what your average monthly rate is. Because what we're trying to achieve here is we want to see a trend line be going down if that's necessary to reach your goals, or go up if that's towards reaching your goals. And, all these topics, if something stands out at you, leave a message in the comments, and I'm happy to explore it a bit more. So again, this is the summary graph at the top here. It summarizes the details of each row below by its topic. So income, we have listed out here. Personal and family expenses. I like to use the client provided data, so I customize it. I don't use the canned ones because unless you use those in your own household, it's too hard to keep it one for one. I make some exceptions, but this is at least here. So we're able to organize and put in all their spend data. I mean, honestly, because they did the work, but if I highlighted these items, they're variable expenses, so that means they're not fixed, they can change. And I highlighted the top ones for this household to focus in on. This household does have separate finances between the spouses, but otherwise, they've made it work, which I think is fine. The right way is the right way. I think a lot of couples do converge at some point, but certainly as we're getting married older and just have different lives established, it makes sense. So really just isolating where are the key areas to drop spending. Now I'm already putting judgments on it based on what I know about these clients' goals. That's probably too premature here, but I'm kind of fascinated by this, right? So I see this because it doesn't have a client A or B indicated. I know that this is their household eating out outside of all the other types of eating out, whether it's client A is responsible, client B is responsible, so on and so forth. So when they jointly decide to go out to eat is a great opportunity to see if they can extend that. Oh, tonight we will not go out. Tonight, if we go out, we're going to go to a cheaper restaurant than a more expensive restaurant. We're going to go out, but skip drinks and an appetizer and dessert. various different things like that. So this is certainly an area to target for them, as well as client A's eating out as well. This is identified as groceries. The client indicated to me that this is also a lot of household items too, not just consumable foods we eat. So I think while it is fixed, it's still an area for improvement. Kids' activities, we can target it. I just think being mindful, because as a parent myself, I mean, these things kind of stay consistent. You drop one, but maybe you add another expense. You drop a daycare fee, but then you add an activity fee. You drop one camp, but then you add another. So I mean, and not only that, is this an expense needed in order for the household to reach their goals in terms of work and so on and so forth? So on and on down the list. We added them all in once per year. We didn't have to add them all in. I mean, we can kind of come up with it. The problem is they have a goal. Their stated goal from this exercise, since they have the data, is to figure out, what's it going to take to be able to pay their estimated tax bills on time. So let's save all this. Great. So at this point, we shouldn't have made any judgments. This is just data gathering. It can be hard. It can be arduous. It can also be super easy. And in couples where I know there's no debt accruing and there's some saving, but we don't know how much, we can make some estimates here. In fact, we might even be able to say, we know this number is, doesn't result in a zero here. So where can we make some cuts? Or more intentionally, can we start saving $100 a month automatically? You set up a bill from your checking account or automated transfer from checking to savings for 100 or 50 per spouse, or however we want to divide it. I've seen couples do this at the paycheck level. They have, $100 per paycheck going into a savings account. The rest goes into the joint checking. That's one example. As well, I personally, I love that method because it really is out of sight, out of mind. I still prefer the automated transfer from your own checking account because it's a bill that you assume to yourself. It's almost reverse credit carding, if that's a term. It's doing the same thing that a credit card does. You're just the one self-funding it as a line of credit you can pull from, and you earn interest instead of paying interest. So if you can wrap your head around that topic, that's pretty good. So there's some question marks. We actually don't know if this is the total amount of taxes due. It could be on the high end, right? This could mean that we're overestimating here. That's fine. That's fine. They are delayed on their taxes and they need to file by their extension. So we'll at least get last year's figures. And provided last year and this year aren't too different from an income standpoint, or even if they are, we can bump this up, right? So we have some flexibility there. I want to stress that it doesn't matter. Perfect data is not what we're looking for from a snapshot in time standpoint. Perfect data can be helpful in business accounting and in household accounting. That's totally something you can strive for. What I found in household accounting is, because we aren't like a business that does projections out into the future, we miss about 10 to 15% of what we're going to spend. So there is this element of a miscellaneous category that we have to be aware of and kind of bump this up, because lifestyle, expansion, budgets, all sorts of things. So we could do that here. Let's assign an amount. And for the sake of this exercise, I'm just going to put it here. I'm going to put a 5% oops budget on personal and family expenses and just bump that up. It's not being spent now according to 2024's data for 7 months, but I'm adding it in. And that is just to project out to the future. So this is realistically what's probably happening. There's some amount between $0 and maybe $1,500 a month, right? So that 1,500 times 12 is the actual reason why they are not able to get on top of their tax bills. Because normally, if you have your paycheck withhold your income taxes, all's usually okay until you get to the higher income earning levels or have company equity and RSUs or some other sorts of income like that. But for most majority of Americans, earning W-2 wage where your income taxes and state income taxes are withheld from your paycheck, there isn't too much of a discrepancy. You either get maybe 1 to a couple grand refund or 1 to a couple grand that you owe. And increasingly, you'll owe more and more and more as your income jointly increases within your households. On the other hand, if it decreases, you might owe less because you could be over withholding, or if you had half a year of income because of a layoff. There's lots of things that can be happening. When you're self employed and you do not have paychecks, but you take money from your business as your income, distributions from your business, partnership, sole proprietorship, all the entities, which I could talk about in another topic. Let me know if that's what you want. You have to actually set aside money that you make for taxes. Now, what if you don't make enough, right? Your expenses are too high to pay your taxes. Well, it's somewhat okay because you figure you're going to grow, you're going to get raises, you're going to increase your business. So for 2023, this household self-employment taxes are due each quarter, every 3 months, based on a specific IRS and state schedule, which you can Google. Or better yet, rely on your accountant or TurboTax for that. But the penalty can be small for not paying on time for your quarterly estimated tax payments. Or even if you got the math wrong and you undershot it and you were making those payments, the penalty is pretty small. Call it a couple hundred. And even if you have a file an extension so you can file your taxes later than April 15th, what you would have owed on April 15th will start to accrue interest, but no penalties, except for the, underpayment amount. So what you want to plan for in that first couple years, if you don't really know and your expenses are high, is just be aware that there might be a couple $100 penalty. It's within reason. It's a slap on the wrist. Don't take that as any sort of financial advice. I'm just capping the downside risk here. And then by April, so you've made all this money in 2023. Then by April of 2024 is when all the taxes officially need to be paid by before they start accruing interest, right? So there'd be slight penalty and there's interest. If you don't file on time, meaning you either didn't file by April 15th or you didn't file for an extension and missed that deadline, or you filed for an extension and are still late, then there's failure to file on time and failure to pay on time and the quarterly estimated penalties. So it's really important to get on top of it. So if I had to choose, always file your taxes on time every time, even if you mean to file an extension in January, just to give yourself a buffer. The next step would be paying everything that's due from previous years. And then the next step is getting ahead on the next one. And now there's various cases and how you want to triage a lot of this. If you owe back taxes and current taxes, there's lots of different strategies, a lot at play here. So I can't give specific recommendations for any one particular situation. But for this household, we can start talking through the numbers, right? So I'm ready to present to the clients. Thank you for all that work together. We've put together your, income. So a very easy answer would be just make $1,500 more per month, except for in order to make $1,500 per month, you probably have to be bringing in $2,200 per month. 22 times 24, you're looking at 30K more of earnings in a year. And you'll have to pay more taxes on that to earn that. So while yes, that is an answer, we just drop into this territory where most financial advisors would be like, oh, don't worry about lattes and coffees and those sorts of things. Just make more money. In this case, it's not that transparent. It's not that easy. And you can see how these cyclical problems start to develop. So let's take a look at these expenses. Now, we know where to target here, but I'm also aware that a handful of these expenses come from things that could be on one of the client's business expenses and not in the household expenses. So bare bones, maybe we can achieve that and see what happens. So let's move through here. Very minor expense, but that could be zeroed out. Oh, in fact, one of the things I like to do this is copying it over. All right, so let's go back and take a look. Now I copied everything over, which is great because now we can start to see the change. So our target is to start lowering the expenses. Now, one of them, I happen to know that the one client can assume these expenses onto their business. So given that, that's part of more the art of financial planning and getting to know clients. So certainly that can drop over there. Um, let's say we assume we can figure out the personal banking fees. Now that's the monthly fee that a bank assesses to have a checking account. But increasingly banks have limits that you have to reach and they can change those. And that's what happened in this case. Let's see what else. I think part of this could probably drop to the business as well, but we'll still keep some allowance there. Cash withdrawal, I'm not sure what could be done there. The one client also said they can make some work on clothing and eating out. Those are just really quick wins overall. Computer software, I mean, that includes their a lot of things. I'm going to keep that there for now. Donations, there's different ways to look at donations. I mean, ultimately, if you're not able to stay on top of your tax bill, perhaps donations aren't something that should be part of your budget yet. That being said, I've heard the reverse. Once you're a generous giving person and you start putting those elements to donations and charitable giving, your budget does work itself out. Or wait till later in life or end of life when you can give more freely and it's super tax advantaged, et cetera, et cetera. This is a big rabbit hole we could get into. In the meantime, I'm leaving it there. Now, this is something they both control, so eating out collectively together. Let's just drop it a little bit, right? There's still some other areas. And let's drop this as well, right? This is already pretty low relatively, so if I did, I'd want to just make some target, but I don't want to go too aggressive. Not sure how I feel about this for now. I think in the short term, to be aggressive, sure, let's zero it out, right? But in the long term, this could just be something that they are price shopping around. So we'll see how that comes up with. And let's see, entertainment subscriptions. So let's say they came to me and said we could drop half of them. So let's give that a shot. Gifts, I mean, is pretty low. Is pretty low. So for now, we'll keep it as it is. So gifts can stay there. I'm sure just like all of our households, like our gifts in Amazon, are they in Target? I don't know. Um, you know, also we don't have a collective look, and I think that's why joint finances is a little bit better than separate, but it's really hard to get a sense of like, what's groceries for real versus everything else. I mean, all of this is groceries. You're looking at 1,000, but it's also household goods. Maybe a lot of people are having this problem. Honestly, important conversation, but for the purposes of me doing my job and for the purposes of the client achieving their goals, which is having more wiggle room, we got to make choices. So these are the way we categorize. This is where we're going to target. We're going to look back at these later too. And I have a report that shows the differences. So we can put in the new figures and compare against our target figures and see where we end up. All right. So here, $60 less is pretty doable. Right? Nothing here has been dramatic, by the way, right? 50 here, 100 there, maybe 5 there. Nothing dramatic. But we have to get to 1,500 or somewhere close. This, who knows? Who knows what this really is? I'm going to keep it for now. It's a type of grocery. These smaller ones, okay. Here, it'd be interesting to see what could be done here. I don't know. It's not a huge spend category, so I don't know if that's where we should target. And same with here and here. So perhaps we could drop this a little bit. Great. I don't see any excessive spend from here, but I do know that this can be moved to the business. And in an ideal world, we're not paying any interest expense. That's $39 per month for each month of 2024 because they sent me January 1 through July 31st data. That's 7 months. So they may have paid interest only 1 or 2 of those months, but if they can get a better handle on it, hopefully this work helps them to do that. Then, that's 40 bucks, right? 40 bucks is like a small treat out or a very inexpensive meal for 1 or 2 of the family members. Okay. Kids activities and kids camps and kids purchases. I don't see kids purchases being anywhere out of the ordinary. Kids activities and camps, I don't know. I don't know what could be done there, honestly. So I'm just going to leave it as is. This is another one that could potentially be moved to the business. So we'll do that. I mean, as far as health and wellness goes, $7, which is like one paid manicure or pedicure. This particular client has admitted that like that stuff's just not important to her. And believe it or not, folks, it exists. So if it's not important to her, I think it's fine. I mean, it's no sense in targeting it. It's not a big figure. Pet, I don't know. I don't even know if that's reasonable to expect that amount. I think we should increase it personally from what I've seen, but we'll see. Um, that's there. That's there. There. So here's another huge area to target would be travel expense. I mean, the only thing I could say is do their best to collectively reduce travel expense down maybe $122. Great. So anything here? Likely not. So life insurance, they have level premium term life insurance, which I tell all my clients to get. If you have minor age children, a dependent non-working spouse or non-income earning spouse, and some other factors. Again, that's not advice, right? These are pretty good specialized decisions to decide on. And these are very low rates for their ages, health, and what they're expecting. Medical, when you pay your own health insurance, it's pretty high. It's possible we could rearrange this into one of the business owners rather than the self-employed. So that could be certainly an area to target and look at. Umbrella insurance is, necessary, and it might actually go up over time as their net worths increase. 401k, I wouldn't recommend it because you have to pay taxes on it to receive as income instead of putting it into a 401k. So in this case, you're likely looking at you you could drop $1,000 of the contribution, but it's really going to result in $600 of income and 400 in taxes. Rough estimate. Maybe for some people, 700 income, 300 in taxes. So it's generally not the place I like to target, and it's the only place this household is saving for retirement. Dental premium, dental out of pocket. I mean, those are what they are. Health out of pocket. It's not much you can do there. Certainly the exercise would be what plan might offer them an HSA, health savings account. So in the back of my mind, I put like an asterisk on this concept, but that can only be changed so many times a year because of open enrollment and other factors. Ring insurance, as with all insurance, we'd have to take a look and see like what makes sense to do here. Does it still make sense to insure the ring? Does it make sense to increase the deductible? Various other factors. Home, mortgages we can't do anything about. Real estate tax actually can go up, and homeowners insurance too, especially if you live in a state like California right now. So I'm not sure what to target here. Electricity, not out of control for the space in their home. Could it be more efficient? Maybe. I don't know. I just generally don't think that these are targets. It's really hard to drop these prices down. Internet, maybe. I think internet reaches a threshold where it's either unusable because it's so slow and or you end up not having any. So there seems to be other places to target. They actually have a second home, and it's pretty minor expenses, at least reflected in their households. Auto, I mean, you saw they have an RV, so auto insurance is high because of the number of vehicles. I have reviewed their policy. It's not high based on a per vehicle insuring. Registration fine. Fuel can be moved to the business. I don't know how reasonable that is, but we'll see what happens. Repairs and maintenance, again, likely to go up, not down. And parking, I don't know. I mean, that one of the self-employed person needs parking. And other, I think this was a smog check. So probably should just put a blanket increase here. But for the purposes of their goals, what could they do in the short term until the income can keep up pace and getting on top of taxes? We want to be aggressive where we can, but make this sustainable. It's not forever, right? When we cut expenses, it's really a trend line. Are we dropping in areas lower collectively? So that's important to look at. Again, that's just a lumping up figure. We did an estimate. This is not client B's FICA or Social Security. It's client B's FICA, which is Social Security paying into client B's Medicare, and both percentages. The employer pays, 6.2 of this of salary, 1.45. The employee pays 6.2, 1.45. There's an income cap where you'll stop paying Social Security. That's not where this client is at yet with their income. So they're paying the full 15%, or let's see, 1.545 is 2.9 plus 0.4 is 3.3 plus 4 is 12. So 15.3. Google it. Right. Whereas client A, we can break it all out. And client A is paying in a short-term disability, being on a payroll system. Client B is not. So that's where we've come up. Let's save this and let's see our aggregate. Okay, awesome. Cool. So let's assume we got taxes too high. Let's hope we did, right? Let's hope we got taxes too high. There's reasons why that may or may not be the case. And it's very complicated at this point for self-employed people, the way their health insurance premiums and any subsidies that they receive or do not receive work. So, but look, we're able to drop it $1,000, and this is a per month 1,000. So it's actually 12,000 per year. So by making some pretty modest changes across the board, certainly not impacting much, just reappropriating expenses where they probably always ought to have been. That's what we're able to do. If we weren't able to do that, then we could drop expenses primarily on the eating out. But I think what you'll come to find is, let's just say this is joint, 7,800 doesn't include any maintenance on the home. So 20, we'll do the exercise for the percentage of housing cost. So I'm going to go ahead and just call housing 8,000. But first we'll do, 24,332, subtract out our tax estimate. So net they're bringing in 18,027. Now, do we take out the, well, let's look it up. Let's Google it. Percentage housing expense, gross income, gross monthly income. Okay. So let's look at this. So gross monthly is 24,332, and we'll call it 8,000. It's probably more because this doesn't include when you need to do your roof, which costs tens of thousands of dollars. You might do it once, but if you did it once every 10 years, then that's $1,000 or maybe $1,200 a year if we divided it out over a 10-year time frame. So it's $100 a month we're not accounting for, as well as new appliances that have died, repairs, etc. But for all intents and purposes, let's just call it this. And let's see, gross 32. So we're a bit high. So I actually think that it's not that this household is having trouble paying their estimated taxes on time. It's more than likely that they live in a high cost of living area, but the cost of their housing is what's mostly contributing to their expense issues. So that is a contributing factor here. 33% housing expense relative to their gross monthly income is too high. So let's look at the other rule of thumb, 36% on total debt service. Now, I think they just had interest expense, but they pay the credit card bill off in full each month. So let's take a look at that other ratio. Instead of 28% for housing, they're at 32, 33. And it's putting a huge squeeze on them. That's typical in high cost of living areas, as well as even high cost of living areas with high income earners. So let's jump to next, looking at the total debt servicing. So we know that they're only debt otherwise, except for oops, went on a trip, didn't pay the whole credit card bill off, except got it on the next cycle, are these two loan amounts. So let's see, 3280 plus 1365. And what is it relative to? I guess it's gross. Well, on all debts. So they don't have additional debt. So we're actually in the clear. It's not as bad as it can seem. Obviously just the mortgages instead of the entire payment, which includes the interest. So both payments, both interests, so payment, interest, taxes, and insurance, pity. We actually did add all that up. And we also have some utility bills and round it up because I think that's sensible, right? I'd rather round up. It's just not a bad thing to do. So maybe they're right at the mark, but being self-employed, the two elements of the self-employment tax, I mean, it's complicated in this situation and it explains why it's so hard. Additionally, I mean, look how much is needing to go to insurance and 401k. That's huge. So what do we, certainly since the mortgage itself and there's no other debt, they're not in any danger of this 36% of gross income on all debts. But that's how people definitely get themselves into trouble. So now the work is they're going to file their taxes from 2023. It's, August 2024. They're going to tell me what the outcome was of that. And we're going to make some decisions on how we did our estimate. Did we aim too high? Did we aim too low? Right. So we need to really figure and calculate this, break out this figure, essentially. After breaking out that figure, I also need to kind of get both of their commitments on all of those expense line items that we made some impact on. Are we intentionally moving things onto the one spouse's business where it should belong, those expenses? Are we moving fuel to the one business and so on and so forth? So really taking a look, are we talking about bank fees? While small, kind of annoying. And I actually calculated this bank fee relative to their bank balances because they keep most in savings, not in the checking account. It's over 2%, which is only $12 a month. But only $12 a month is 2% annually of their checking account balances. It's pretty obscenely high. So anything we can do to eliminate that. So essentially, that is where we are at. You can get the data you need, right? By working with your pay stubs if you have them, your pay stubs plus actual tax returns. So if you owe $12,000 in federal income taxes on your tax return, that's $1,000 per month you need to be adding to your monthly expenses. Ideally, you're also moving that 1,000 over into a savings account as your paychecks hit. So it's out of your bank account. In fact, mortgage hits on the first, rent hits on the first, your personal tax savings money hits on the first to move out of your budget. And that's where getting paid every 26 pay periods or every 2 weeks versus twice a month can get complicated. But complications can't allow you to not do something. If 1,000 is too much, we start with 200. In this case, there just wasn't a lot of extra. So we're trying to, more equitably and smartly divide all of these expenses up. So this is part 2 of 3 for budgeting. And hope you've enjoyed this and looking forward to putting more content together for you. A lot of other ideas came up in this video. So mark in the comments anything else that you want to see from a financial planner's perspective and how to blend these, data elements of financial planning with the art of actually knowing who the people are and how to get them to achieve their goals. Thanks.